Jerome Powell decoded. The chairman of the Federal Reserve spoke on Friday, and that's what we're going to discuss today. My name is Michael Cheever. I started 23 years ago in real estate at zero, closed thousands of transactions, and I'm thankful for the opportunity to serve now as the general manager of the Rawls Group. We're going to focus in today in detailing what Jerome Powell talked about on Friday and what does that mean for us as we move forward. Statement one, all told, the healing from pandemic distortions are efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Item number one to focus on in this statement is the pandemic distortions. What he's talking about there is the massive disruptions that we saw in the supply and demand chain. So the supply chain and demand for the products, services, and goods that are in that supply chain. We saw great evidence of that in real estate. We saw that the supply went way down, the demand went way up. Same thing happened in cars. We noticed that the supply of cars went way down and the demand went way up. So there was things, supply and demand wise, that were severely distorted during the pandemic. We're seeing a return to normalcy in the supply chain, which is great. Efforts to moderate aggregate demand. As you think about this, the Fed has two levers to pull. Number one is interest rates. So if they want to tighten down lending and the ability to get loans, they raise interest rates. The cost of money goes up. If they want to increase the borrower's ability to borrow, they lower interest rates. So this means I can go borrow money for less and thus have more money to do things with. The other part of this is quantitative tightening or quantitative easing. $1.5 trillion was pulled out of the economy over just the last couple of years. As they raised these interest rates, they pulled out money. So the combination of those resulted in what we've all felt over the last 2 years. Money's more expensive and there's less of it available to us as the consumer and to businesses. Anchoring of expectations. I will say, while frustrated during that process, I have to tip my hat to Jerome Powell and his team. They set, and I'll just call it downright gloomy expectations for what we should be looking for relative to how much they would lower interest rates and when they would lower interest rates. There was a big cry from a lot of powerful people to lower these interest rates, and they sat tight. And they did that intentionally. I believe they did it intentionally to lower the amount of speculation that was happening on those interest rates being lowered. The speculation, think about this as like gamblers, right? This is people who bet on what's gonna happen in the future. And they'll drive markets to unreasonable levels based off the amount of speculation that occurs. Think about the NFTs. This is a great example. So these NFTs come out and they're selling digital pictures of things for sometimes millions of dollars. Well, that was a lot of speculation, and then what's happened? The NFT market has decreased overall by 90% because it was something that was driven primarily by speculation. Really, those three things in the statement are what we're focused on to say what's gonna happen next. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. The upside risk to inflation have diminished, and the downside risk to employment have increased. So decoding this in an overview, interest rate cuts are coming. Whether they're slow at a half a basis point or more, they are coming. And here in a few weeks, we're gonna see when this turns from rumor and interpretation into actual news, when they meet and when they formally give notice of what their policy is gonna be. So good news is on the way. We'll just see how and when it comes. We had a question today, so we appreciate it. Can a buyer's agent terminate a buyer brokerage agreement with a client if that client is being unreasonable? The answer is yes. My encouragement to you as an agent is ask yourself, am I in alignment with the elite level service that and the experience that I am committed to delivering to this client? Am I professional? Am I prompt? Am I on point with the service that I'm delivering? And if the answer is yes, then it's actually the right thing for you not to work with that particular client anymore. Not saying anything good or bad about the client, not saying anything good or bad about you as an agent. What we're saying is we're saying that us working together isn't the right fit. So in that scenario, it's best for you and for the client if you agree for them to find another agent and for you to find another client. Great question. We appreciate it. Crush it. We're stronger together.